It's really about how do you manage your wealth and make decisions that's going to help you leave a legacy, not only for yourself, so you can enjoy your life while you're living, but leaving something that will set up the next generation or some cause that you're really passionate about. So I think big picture, and it's all about making profitable business decisions with your money. So no, I'm not typical. I'm not Mr. Conventional that's going to tell you to buy stocks, bonds, and mutual funds. And certainly not going to tell you just to focus on your taxes and not think about making money. Like, no, we're going to generate a profit and figure out how to reduce the taxes as well.
Have you ever wanted to get involved in real estate development but didn't know where to begin? Do you think real estate development is only for the large hedge funds or major corporations, the big guys? Or have you done some development in the past and are looking to scale up? If you answered yes to any of these questions, then this podcast is for you. Welcome to the W.I.R.E.D Wealth and Real Estate Development Podcast. I am your host, Nick Smith. Get ready to have your mind blown and rewired as we discuss all aspects of creating wealth and real estate development. Good day, everyone. This is Nick Smith. I'm your host for the Wealth and Real Estate Development Podcast, better known as W.I.R.E.D. This is episode 18, so I want to welcome you all to another episode of this podcast. If you're watching on YouTube or if you're listening to wherever you listen to podcasts, I definitely appreciate your support. I definitely encourage you to like, share, and subscribe any episodes that speak to you, so we can further advance this message on creating wealthy communities, wealthy families, and wealthy individuals through real estate development. Today, we have a very special guest, one that I've known for a few years now, several years. A gentleman by the name of Mr. Eric January. Eric is the owner and CEO of Conduit Investment Advisors. He's also the owner of Eric O'Neill January & Co., which is a CPA firm. So we are going to talk some money today. And I definitely, Eric, welcome to the show. And I want to thank you again for agreeing to come on. Thank you. Welcome.
Thanks, Nick. Thanks for inviting me, and I'm looking forward to get wired up.
Good deal. If you can, give my listeners a little bit about your background, where you're from, what you're doing, what you're up to now, and where you're going.
Sure. Background. I like to say always an athlete. I played college football at a great university called Sam Houston State University, which is in Conference USA, captain of the team. I won a conference championship that I'm still proud of, wore this ring with honor when we won the championship way back in the 90s. And after that, I've always wanted to be a self-employed person. Anybody that knew me since I was a little kid has known I've never, ever wanted to work for anybody. One of my college professors in college told me when she realized that she was my accounting professor, and she saw that I was good in accounting. And she said, Eric, every business needs a CPA. The next day I changed my major because I knew that was my way out of corporate America. From finance, I didn't want a job. And it has been one of the best decisions I ever made because here I am 28 years later practicing completely for myself as a CPA. I've got staff that's work for me, but I've been doing it for 28 years and I have a life of no regret. I've been married for 24 years, got 3 kids, and the oldest just graduated from Howard. The other one is in Howard. Go to Howard and get some Dre's chicken. That's his Howard hustle, as they call it.
Nice.
And my daughter is in school, and I've been helping people make good business decisions my entire life. That's the basis of it. The reason my business is called Conduit is because I realized one day after one of my real good clients, she had a nail shop at the time, and nail shops were really big, and a nail and barber shop. And somebody had sold her an investment and had just taken her for a ride. And at this point in my career, I had my Series 6 and 63 licenses. And I realized this person had just saw a sucker and he had taken advantage of her. And I said, people just don't need a CPA, they need a conduit. And that's when the whole genesis of Conduit started. And that's why people can call me today at 877 Conduit and you'll reach me, reach somebody at the end of the line. And because I really believe that people need information. And once you have the right information, they can help you make better decisions, but they also need the right products. And that's also after that episode, realizing that people needed more is what made me start writing the books after I made a real bad decision, which it was a faithful decision. I thought the Lord was leading me to Dallas to make a bunch of money.
Mhm.
I thought, but he actually led me there to teach me a lesson. It wasn't making a lot of money, and that's where my books came from. Called MoSense, also Gainology. Gainology equals MoSense, and it's books that are based on the physics principles. And says in Deuteronomy 8:3, man doesn't live by bread alone, but by every word that proceeded out of the mouth of God. Well, a Christian will say that's the 26 books in the Bible. Muslims will say that's the Quran, and Buddhist people will say whatever their religious text is. Well, no religion and no person will refute that God didn't create physics principles. They work. We just need to learn how to make them work for us. And that's what my books are about.
Man, it's a good deal. Good deal. And you touched on, of course, you have your CPA firm. And when a lot of people hear the term CPA, they automatically just think taxes.
Right.
You know, they just think, you know, this person is here to, you know, help me save money or help me prepare my taxes. But your CPA firm is slightly different. I mean, your overall organization, the way you are structured, I mean, you're just not your traditional quote unquote tax preparer or tax advisor. I mean, you go over and above the taxes. I mean, you want to create a better strategy, an investment strategy. Correct me if I'm wrong.
You're absolutely right. And most people that meet me, if I didn't tell them I was a CPA, they would never guess in a million years until we start talking about some technical stuff. Because I'm one of those a few people that can be technical and big picture at the same time. I can switch to both sides of the brain. And my firm is definitely not typical. We don't do any audits. When I first got started, way back when I was 25 years old, I did audits and I did everything in public accounting that I could possibly think of. This was after being an investment advisor and owning a mortgage company. And that's at 25. By the time I was 25, I had already owned a mortgage company, had already been had my CPA license, and did three things before 25. And then after that, I said, let me just focus on the CPA thing for a little bit. And I've done a little everything in it. But I realized when that happened to my client, people just didn't need a CPA. I had to bring more to the table than that. And I wasn't interested in doing audits for people. I do tax returns and we do some accounting, but it's really about how do you manage your wealth and make decisions that's going to help you leave a legacy, not only for yourself, so you can enjoy your life while you're living, but leaving something that will set up the next generation or some cause that you're really passionate about. So I think big picture, and it's all about making profitable business decisions with your money. So no, I'm not typical. I'm not Mr. Conventional that's going to tell you to buy stocks, bonds, and mutual funds. And I'm certainly not going to tell you just to focus on your taxes and not think about making money. Like, no, we're going to generate a profit and figure out how to reduce the taxes as well.
Good deal. No, man. I actually started reading your books. And again, for those that are watching on YouTube, you can see his books proudly displayed behind him. Started reading or read through the Gainology. I believe you updated the first edition of MoSense. And you brought up some key points that I think were interesting, and I definitely want to hit on those and touch on those today. One, when we think of wealth, a lot of people, and you bring this out in your book, and I want you to elaborate on it. A lot of people look at it from a financial perspective, but not an economic perspective. You draw the difference between financial and economics. Can you elaborate on that?
Sure. So one of the things that I realized when I started writing the books is that our entire financial system is based on financially educating people and telling them how to buy, why it's wise to buy stocks, bonds, and mutual funds, and to open a bank account. And they pay attention to statistics like the number of unbanked individuals in society because they feel like everybody should have a bank account. And they tell you that when you put $1 in the bank or $1 million in the bank, whether you're saving that money. Well, what I found when I just started looking objectively at it from a physics law standpoint, a law of gains and losses, because that's what physics is, there's only so much physical momentum in the entire energy in the entire system. And as a result of there only being a fixed amount of energy, although it's a large amount, it always results in gains and losses as particles collide. Well, that's how it is in society. there are always gains and losses that are taking place. Well, what I discovered with financial principles, and why I say think economic and not financial, is that many of the principles that we are taught financially are just trying to get us to think economically backwards. Because we realize in the real world that there's only so much real estate to go around. And as a result of it, we do what we can to compete to get some of it. Well, financially speaking, they will try to convince you that there's more real estate out there, or it doesn't really matter. That owning real estate is not really important, and you shouldn't have any of it in your portfolio. And I'm not just a real estate type of person, but I'm just saying that to draw the example that there's a distinct difference between thinking economically and thinking financially. When you're thinking about thinking economically, you are really dealing in the real world of gains and losses. You're not talking about theoretical gains that are based on the earnings per share that you'll never get with a stock certificate. But you are thinking about, okay, if I invest in this, what is my real return on investment going to be? How much cash am I going to get from investing in this particular business? Not an earnings per share, which is an accounting statistic that really means nothing.
Right, right. We live now in somewhat of it's a paper environment, and you know, a lot of people don't realize how a lot of this value is just literally arbitrary. You know, a lot of people's stock portfolios, things like that, even the money that we have, because you talk about this in the book, and of course we all know it. I mean, we came off of the gold standard. I think it was in the 70s. I forget the exact year.
1971.
Yep, 71. We came off the gold standard. So I mean, it's a piece of paper. That's what the dollar really is. You know, and I think one of the things that is cautionary for us is that so many people don't really understand it. You know, they don't, you know, get the system, you know, as far as, you know, the monetary policies and just things like that. How do you think more people can become educated about true economic wealth versus just financial means?
So that's a great question, and the solution and what the answer is to get my books. And I'm not saying that just because my goal is to sell books. The goal of me writing those books was to educate people. And what you just mentioned about the fractional reserve accounting system that we have, and money, and you were alluding to that when you said money is just paper. Well, the reason money is just paper, and the reason that people accept it and people think that they have more money in the banking system than they do, is because of a fractional reserve accounting system. And my books elaborate on that in detail. Sometimes people will say, well, Eric, this is a little too much detail. Well, I believe that if people understand what environment and how the system is set up, it can help them make better and more informed decisions. That's why I talk about in that first book, which was published in 2005, it's been so accurate on everything that you see going on today that they also called me the Einstein of finance, because everything that I said in that book was so right that people were initially, when they came out, said, Eric, there's no way that the banking system is going to collapse. And remind you, that book came out in 2005. They said, no way the banking system is going to collapse. I'm at a home buyer seminar that Wells Fargo was participating in Chicago, and I'm passing out flyers to everybody in 2005 and say, hey, now is not the time to buy a house. You're paying more than what you can rent the house out for. That's the number one sign that the housing market is about to collapse. Well, that's what's going on right now in some places. People paying more for a house than they can actually rent it out for and think it's a smart investment. And I was telling people then, don't do it. Well, if you want to make informed decisions about your money, and informed decisions that will work today, tomorrow, and 100 years from now, what I would suggest you do is get the books, because I wrote the books using physics principles. I didn't want to know what I knew. What I knew is what I had been taught through a college education, through securities licenses, and in the real world through taking continuing professional education courses as an investment advisor at the time and as a CPA. Most of that stuff works, but it's that little bitty yeast, the little bitty yeast that's mixed in it that will pollute all of your thinking. I correct that yeast so that when you get these principles that are based off of physics, They will work for you. They will work for your children. They will work for everybody. But you have to know what they are. And that's why I wrote the book, because I wanted to write something that would endure beyond the time period, because 2005 is come and gone. I don't want to have to be revising a book on this version. The reason I switched it from Gainology or from MoSense to Gainology, one, MoSense sounded a little too ethnic. And I didn't want people to think I was just writing it for African Americans.
Mm-hmm.
And then two, I really wanted to simplify it because some of the stuff that I had in it initially was very detailed. And I had to take some of that detail out. And I also didn't want to offend some people that used to refer me a lot of business.
Gotcha. No,
Continue to offend.
never want to do that. No, never want to do that for sure. And definitely no, and we're going to put links up later. You know, I have you share information where people can get your books from, you know, because, you know, I wasn't a physics guy in school. So I took physics in high school and I had to pray my way through. So when you start talking about protons, neutrons, electrons, all that stuff, I got to connect it. I'm gonna have to read it again to really, really put it all together. But I did pick out, I think with any book, you have to pick out, you know, really, there's high level things that everybody can grasp. And I'm not going to talk about the book the entire episode because I do want people to support you and grab the book. But there's a couple other things I did want to just, you know, kind of touch on when you talk about net worth, because again, a lot of people that listen here are real estate investors, aspiring real estate developers. You know, we're in the real estate arena. But you actually said you should stay off of the net worth scale.
That's right.
Net worth is overrated. And can you elaborate on that?
Right. So the Federal Reserve, in one of their comments, they make the comment that your net worth is your worth. And your net worth is not your worth, because a net worth, for those of you all that may not understand, a net worth is simply taking the fair market value of all of your assets. Say you own $100,000 worth of things, minus your liabilities. If you owe $50,000, your net worth in that example is $50,000. And they will tell you that is your worth. Now, many people may buy into that because they want to maybe be on Forbes billionaire list of one of the richest people, and they'll tie into, yeah, that's my net worth and that's my worth. Well, we are so to put our value in a monetary sense, we're depriving ourselves of the real thing, because a net worth doesn't express how much money you're making. You could have $100,000 of assets or $1 million of assets and be generating $0 in income.
Right.
So the net worth is not an accurate measure of how well you're doing. When a banker, although they advocate the net worth statistic, they don't want to know what your net worth is alone when you apply for a mortgage. They're asking, how much money do you earn? How long have you been on your job? What type of assets do you have? Do you have a 401k, a 403b? Do you have a whole traditional whole life policy? What's the cash value of it? So you so much more about you other than the fact of what is your assets minus your liabilities, because a net worth has never ever been an accurate measure of how much and where a person is going. And in the book, I explain that even further to explain what statistics you should be looking at when you're trying to measure where you're at. And that's why I talk about stay off the net worth scale, because too many people get caught up with it and say, oh, yeah, I'm a millionaire. I'm an accredited investor. And I can invest in just about anything I want to. And you can end up making some very poor decisions based off of this arbitrary definition of a net worth, because assets today in an inflationary environment maybe they're overinflated. A lot of what people are buying today, the prices they're paying for cars, the prices they're paying for houses, these are inflated values. And if we go into a deflationary environment, if your assets value drop by 50%, does that mean you're not as valuable? Or maybe with the housing market, people often buy things based off of comps. And they look at what comparable houses, and Nick, you know this better than anybody. They look at what comparable houses were. If you're giving somebody a broker price opinion, and what if the house was selling for $1 million today, but in 6 months is only selling for 750? What was the real value of that house to begin with?
Mm-hmm.
So net worths may fluctuate based off of asset values. Debt value doesn't change much because you signed a contract for it. But those asset values are going to go up and down based off of the market that we're in, based off of the price. So stay off the net worth scale. Get the book so you can understand what the true value of your wealth is and understand where you're going. Because the net worth is not going to help you make a good decision about where you're at, where you're going, and what you need to do to get to where you want to be.
Right. No, and I, I've been around real estate development really since I graduated college when I came out working for the city of East Chicago. And I've been around development and been around real estate. And you do have a lot of real estate investors, especially they tout that net worth. I own this amount, I own $1 million, I own $100 million of real estate. But just owning an asset and being able to live off of an asset are two totally different things.
Yes.
You can't feed your family off your net worth. That's the reality. You can't buy groceries. You can't pay anything off of your net worth. But you talk about this in the book. Passive income is the name of the game. Your returns on your investment, and that's definitely something. So we're gonna encourage you again. Pick up his books, but want to shift gears a little bit because you are a CPA. So you have seen probably at this point thousands to tens of thousands to maybe even hundreds of thousands of tax forms and submissions for persons that needed their taxes done, some good and probably some bad. I'm sure you've seen some of it all. Again, my audience is real estate investors, which represent entrepreneurs, entrepreneurs. Right. And most of us as entrepreneurs are not good at, the organizational stuff. A lot of us are not good at that in that arena, in that area. I mean, we like making deals, especially real estate investors. I mean, we like being out there making deals. We don't like having to keep track of receipts and all this other stuff. As entrepreneurs, and then this is just a general, what are some of the biggest mistakes that you've seen in your real estate investing clients as they get ready and prepare and even file their taxes? What are some of the biggest mistakes that you see in your real estate investing clients?
Right. So one of the biggest things, and one, I want to applaud you because what you just mentioned is there are really two different types of business people that you have out here. You have some people that are very good administrators for the most part, and they can dot every I and cross every T, but they're often not very good salespeople.
Right.
So you have these two vast universes where one is an excellent salesperson, but don't ask them to do anything administrative because that's just not their forte. But then you've got another group of people that dot every I and cross every T, but don't ever put them on the phone with a customer because you're going to lose the entire customer base. And occasionally you have people that can do both. And that is a blessing when you can do both. But even when you can do both, what happens is these people often choose to contract some of those services out that are where their time will be more productive doing something else in order to generate the money, or maybe they just like doing a lot of the administrative stuff and they just dabble in some of the administrative stuff. So I say all of that to say one of the biggest mistakes that I see people make is trying to be something that they're not. If you know that you are the type of person that's going to go out and sell, and you can sell all night and day. I was just out in Chicago. I went out there, I had an appointment. And while I was in Chicago, I'm like, you know what? Because that's where I'm originally from. I said, let me just go ahead and just call some people. And I just started calling them, man. It just brought me back to my insurance days when I was picking up the phone and calling hundreds of people a night. It didn't matter how many people said no. I was trying to get to the yes. I just loved it. Here I am at my age, and I'm still loving that because that's how I am.
Right.
Yeah, that's how I was wired. So first thing is be yourself. If you know that you are not the administrative person and you won't dot every I and cross every T, outsource that to somebody else. And if you can't afford to outsource it to somebody else, automate as much as you possibly can. Get an app to track your mileage, because what happens at the end of the day is when a person comes to me and I have to do their tax return, or one of the staff persons have to do their tax return, we're asking them questions. How many miles you drive? You know.
Right.
How we gonna you missing a huge deduction? You need to keep track of your miles. Get mileage IQ or some sort of app to track your miles, or go old fashioned. And every time you get in the car, reset that odometer and say how many miles you drove. At the end of the day, I did 76 miles, and write it down. September the 20th, 76 miles business, and went here, there, and you kept the track. So if you want to go old fashioned, you can do that, but get an app. If you're spending money, at the end of the day, try to use one credit card that you're using, whether it is something that you're trying to accumulate points with, or it's a direct debit card. Try to use one for everything that you have that's related to business, and get a bank that's going to allow you to download as much of your information as possible. Link it to some sort of accounting software. I don't care what the name of the accounting software is. Link it to that accounting software, and then let them automatically merge. So at the end of the day, even if you don't know nothing about accounting, all of those transactions are in there, and you can hand it off to somebody that's a financial professional like me, and then we can make heads or tails about how much money you made and how much money you spent. And it's going to make it easier for, so don't deny who you are. If you know you are not the administrator, and that, I'm not saying don't try to discipline yourself, because that when you're in any business, the people that succeed over the long term are the ones that have discipline, and they're doing things whether they feel like it or not. So, but don't try to make yourself an administrator if you're not a good administrator. Marry yourself with somebody that's an administrator, and you go out there and sell. And if you're a great administrator and have a good idea, you can find somebody to go out and sell, where the two of you all can work together. Or if you are a one-man show, then you hire a contractor out to do the part that you're weak in. Because I know that is the biggest mistake, because that's not just about taxes anymore. There are people that are gifted, got the gift of gab. They don't have the gift of administration, and they try to run a daycare.
Right.
Or they try to run some sort of complicated business, and the same thing happens. It results in not necessarily failure, but mediocrity. So they end up frustrated because they never realize the goal that they want to achieve, because they didn't tap into the other, what their true potential is. Because what the Bible says is a man's gifts will make room for him. Not your degree, not how much money you have, but it's your gift. So, but that's my point. So automate as much as you possibly can. Use an app to track your mileage, and then download all of your banking information into a system, whether you're using cryptocurrency or whatever. You got to keep track of those records, and you have to be very diligent about it. I mean, some people are still keeping receipts, and if you can scan those receipts into a bucket, and don't commingle funds. If you have a business account, use the business account 100% for business, because the moment you start using it for personal purposes, and if you were to ever get audited, the IRS will make you justify every transaction. It doesn't matter that you went to Office Depot. You won't be able to tell them that you went to Office Depot and bought supplies without the receipt, because they'll see that you can buy things in Office Depot. You can buy water. That doesn't mean you bought the water from the office. You can buy a computer. They want to see, okay, let's go to your office and let me see this computer. They can make you try to prove everything, but if you're using one card and it's 100% for business, they won't necessarily ask you to justify every single thing. So you don't want to commingle funds. That's like one of the biggest mistakes a person makes. Start a business, get it organized. And if you need to know what type of entity it needs to be, contact me. Look me up on the web, because there are many types of entities, and it depends on what your goals are, what your end goal are. You trying to bring in some investors? What are you trying to do? What do you want to do tax-wise? There are different strategies depending on what you need to do. But don't deny who you are. I think that's the biggest thing, because from years, in me, I'm speaking to the choir. For years, although I'm a CPA and can be very detailed, I'd rather be big picture, looking at the big picture. But when it's time to be detailed, I can be asinine about it.
Right. No, man, this is medicine for me, because I know Since I've been a full-time entrepreneur, taxes has been an area, it's been my Achilles heel. I'll be
Hmm.
100% transparent. It's been my Achilles heel. I won't say I don't have it all figured out 100% because I'm still working on it. But one thing I did do, and it definitely helped as far as the record keeping portion, was I was able to, about a couple years ago, I hired a bookkeeper, that on a monthly basis, I pay a flat monthly fee. And, she actually organizes all of my expenditures and income, in my business bank account. And, when somebody is watching what you're doing, you are that much more vigilant. Not to say that I wasn't before,
Hmm.
but I know she's looking at everything going on in my bank account and I got to answer to it. It definitely makes you that much more vigilant. So, this is, like I said, this is medicine to me.
So you have one of those Michael Jackson moments. Somebody's watching me.
Definitely. I think and you need that. You need somebody watching over what you're doing. Like you said, especially, I mean, we're not CPAs, by nature. Most real estate investors I know, whether they're fixing, flipping, whether they're buying, holding, or whatever they're doing. You have some that are very analytical. You do have some, but like you said, you
Sure.
typically do not have that combination where you have the very analytical plus the rainmaker,
Right.
in the same person. So
Hmm.
at some point in time, you do have to bite the bullet and bring on people to, strengthen you up in areas and places where you're weak, and help just boost your business. One thing I had to understand and learn, and you could definitely expound on this too. A lot of us treat our businesses like hobbies.
Right.
you know we don't run it as a business,
Hmm.
and I'm sure you've seen it in your profession, and it takes time for that.
Yeah, and one of the things that I noticed, because and I say this in one of my seminars, so I'm giving you all a free tip, is most people, particularly in this, like I said, I'm originally from Chicago, born out of state in Texas, but raised in Chicago for the majority of my life outside of 2 years. And one of the things that I like to distinguish is a business from a hobby, or from a hustle.
Mhm.
So in Chicago and in many cities, people have a hustle. That hustle may be something they just started part time and it grew to something much more than it was. But they never really took the time to formalize it. They may have incorporated the business, may have organized it as an LLC, may actually have some people working for them. The business could be generating millions of dollars. But the distinguishing thing between a hustle and a business to me is the fact, are you doing your accounting? Do you know what your numbers are? Because a hustle, you don't necessarily always pay attention to those numbers and the details you do. You may not be filing your tax returns on a routine basis because you're still thinking short term. You're not thinking long term in the sense that, hey, I want this to be around for a long time. I don't want the IRS to come take nothing from me. And I want to be able to leave something to the next generation. My kid wants to get in this business. When he gets old enough, he's going to join, and it's going to be Nick and Son or Eric and
Right.
Son. And now we're on a billboard like Sanford and Son, doing our thing. So I think that we have to take these hustles and make them businesses. We can't, because with a hobby, from the IRS standpoint, a hobby is not something that's engaged in for a profit. Well, most people that are out here taking pictures, doing Uber, and all of these different things, they're doing it because they want to make some money. So these are clearly not hobbies. It's just they're in between the hobby, the hustle, and the business. And
Mhm.
we need to make this a legitimate business. And that means you need to organize. You need to have CPAs, tax advisors, legal people. You need to be keeping track of your records so that if anybody ever questioned you or maybe wanted to invest in your business, you don't have to scramble and say, hey, Eric, I need some financial statements tomorrow. Well, tomorrow is impossible
Right. Right.
because got somebody that wants to invest in this deal, but you don't have your numbers together, and now you want to rent it, pull it out there. No, you should know that stuff and have it not just for somebody else, but for you primarily to help you make a business decision, a management decision. So make those hustles businesses.
Hmm. And that goes for real estate, because some
Yes,
people that's in real estate, they treat it as a hustle and not as a business.
that's right. One deal to the next.
Yep, I'll never forget the first two flips I did. This was back in 2017. They were actually profitable. I made probably about 20 to 25 grand on each one. but I didn't know that I should have set aside a portion of those earnings for taxes. I just didn't. I took all of the earnings. I took all of the earnings that I made, and I bought 2 other properties. And when it came time for taxes, I had this bill, and I was like, okay, wait a minute. We got to work something out on this. I didn't know. These are typically not conversations that we have, especially, in the African American community. We don't really talk, because a lot of I speak from my neighborhood and my neck of the woods. A lot of our parents, were not entrepreneurs. And that don't make them bad. Of course, our parents did what they had to do, but they were not entrepreneurs, and it's impossible for somebody to give you what they didn't get. So it has been a learn as I go journey, and I think we all as entrepreneurs do that. I want to hit on just a couple other things before I let you go, because I know you have a hard stop. There are certain vehicles when we talk about cost segregation, 1031 exchanges, where people can pretty much defer their taxes when they're buying properties. Those things have been kind of on the chopping block recently, through some of the government. Some of them want to get rid of some of these because they view them as ways of people just avoiding taxes, things like that. Just curious to get your take as a professional. Do you think some of these legal avenues are in jeopardy of being lost in the future?
No. The depreciation, 1031 exchanges, and self-directed IRAs, that stuff is so ingrained in society, and so many people in Congress, their family members, and everyone are taking advantage of these tax loopholes that they are not in danger of going anywhere unless people read this very first book and learn why I say we should get rid of the tax code altogether.
Yeah.
Right. So, but no, I don't think that they are in danger of going anywhere because they're just so ingrained in society. I mean, it's just like if you have a corporation and decide to have it treated as an S corporation. There was some talk about getting rid of that at one point. Man, that was probably the briefest conversation I ever heard about getting rid of something, because so many people are benefiting from not avoiding paying some sort of self-employment tax through having some sort of S corporation. That's just something that's completely off the table, because that's ingrained in the way that we've been taught to minimize our taxes. And now some of the things that may disappear, and they are scheduled to sunset, are things like the credit that you get for electric vehicles. Those things sunset at a certain point. The credits that people are getting for housing, that sunsets. That's just some mandates that the government wants to try to encourage people to buy electric vehicles, get energy efficient houses, and stuff like that. Well, that stuff was sunset. But other things that are just pertaining to ordinary business, we will always be able to deduct the money that we spend on meals and entertainment. The only question is, will we be able to deduct 100% of it, or just 50% of it, or 25% of it? Because they're going to do it, because they know business people have to entertain, and that's a reasonable and necessary business expense. So they're not going to get rid of it. They just may not allow you to deduct 100% of it.
Right.
So that's not going to happen. And I definitely encourage everyone that's listening to take advantage of every single loophole that makes sense. That you don't do something just because it's a loophole. Don't spend money just to spend it. That's how you go broke. But spend money that you would normally spend, and if you can get a tax deduction for it, great. Figure out how to do it, just like the employer retention credit, which I'm helping people with right now. That's a huge thing when it initially came out. Many people didn't understand the significance of it, but everybody that maintained employees during that time period understand it now, because they're getting a lot of money back through the employer retention credit. You should contact me for that if you haven't already applied for it and you had businesses during the pandemic.
No, good deal, man. Well, one last question, and we're going to let you go. Because we all know all tax preparers are not created equally. Some tax preparers are more geared toward, your just regular 1040 employees. I remember when I first became an entrepreneur, my sister, she has a CPA. Oh, she's not a CPA, but she has an accounting degree. So she used to do my taxes. And she actually fired me. She said, your taxes have gotten too complicated, and I'm not putting myself at risk or you at risk. So you need to hire somebody. My own flesh and blood. She literally fired me. from doing my taxes, and that was definitely the best thing for her and I. But how can somebody identify a appropriate tax professional, appropriate CPA for where they are at the stage in their business life?
Sure. So when you mention CPA, one of the big differences, a lot of people go to some of these tax prep services, and just like your sister was kind enough to realize that she had outgrown you, or you had outgrown what she was capable of providing or wanted to provide. She's an accountant, so she could have done more. She just would have had to take a little more continuing education in order to do it. So I think one of the big things to do is recognize who you're dealing with, first of all. When you're dealing with a CPA, for the most part, because we had to pass a uniform examination that included taxation, most of them, if they've been doing it for some period of time, are going to be pretty knowledgeable about how to do a tax return. And if they don't, they know how to research, because there's no two tax returns that are necessarily always alike. And there's always something that you have to research. So nobody's going to know it all, because the tax code is just too complicated for that, too vast. So one, know who you're dealing with. Are you dealing with a CPA, an enrolled agent, or somebody that's just doing taxes? I mean, I say it in that order because the highest order of excellence typically is starting with somebody that has the professional credentials, which is something like a CPA. And they've have to have been doing it for a while, because not all CPAs do the same thing. I do a lot with real estate investors, people that have daycares, home health assistants. In terms of individuals, most of them have a lot of real estate. But then the businesses range from home health care and daycare centers. I do some stuff that are in between, but those are the largest bases that I have. So recognize who you're dealing with and what their specialty is. Because some people like doing 990s. As a CPA, I don't do any 990s besides one. And that's just because I love this organization called the I.W.I.R.E.D organization. It was founded by the grandchildren of I.W.I.R.E.D. Other than that, I don't want to do nothing with the 990. Some CPAs thrive in 990s. So you need to know who you're dealing with. But then you have enrolled agents who are not CPAs, but somebody that's gone through a comprehensive exam through the IRS to learn the Internal Revenue Code, and they can do a whole bunch of tax returns, may not be competent at doing a lot of business tax returns, because many people, that's where your sister came in. You have to understand income statements, depreciation, and different things before you can do a business tax return. Whereas if you just understand what to plug in the box, get a W-2 and say, oh, W-2 goes here, itemized deductions goes here, you can figure that out.
Right.
So know who you're dealing with, and know ask them what their credentials are and what their experience are. And then also ask them for references if it boils down to it. And most of the time, ask for referrals. If you see somebody that's in business they seem to be pretty successful, ask them who their CPA is. They share who their accountant is. And then inquire and find out. So word of mouth is one of the best ways, because just looking for it over the internet, I don't know that is the best way. You'll find people that are doing it, but are their prices going to be right? Is that some business that you want to support? Or are they going to treat you fairly, or are you just going to be a number in the wheel? So I think that because when you're giving your confidential information to somebody, I believe you should really be giving it to somebody that you can trust.
Gotcha. Well, Eric, that is our time for today, for sure. Definitely, again, want to express my gratitude. It is a ton of information, ton of valuable information that you share with us today. For individuals that want to get in touch with you or even want to purchase your books, how can we do so?
Sure. Okay. You can log on to conduitadvisors.com, CONDUIT advisors.com, ADVIOSORS. Or you can just call me at 877 Conduit, 877-266-3848. And you can order the books right there directly on my website at conduitadvisors.com, or just reach out to me at 877 Conduit, and I'll show you another way that you can get it. But those are the easiest ways. 877 Conduit, or conduitadvisors.com, or conduitcandoit.com.
Good deal, man. Well, again, Eric, thanks a lot. Again, I want to thank you all for listening today. Thank you all for joining us for this episode. Learned a ton about just financial management, fiscal management, economic management, all of that. So hope this truly benefits. Again, if you are liking what you're hearing, please share, like, subscribe, comment. We definitely want to spread this message again about creating wealthy communities, wealthy families, and wealthy individuals through real estate development. Again, I'm your host, Nick Smith. This is the Wealth and Real Estate Development, better known as W.I.R.E.D podcast. And let's get wired up. Take care.
Thanks for having me.
Thank you so much for listening to today's episode. If you enjoyed it, please share this content with someone else who would benefit from it. I'm looking forward to having you with me on the next episode. Now go out and create some wealth and real estate development.